I would now like to go over problem 11-17 with you in your textbook. Financial data for Joel de Paris, Inc. for the last year is followed, and they give us their balance sheet. And they also give us the highlights of their income statement. The company pays dividends of $15,000 a year. The investment in Busan on the balance sheet represents an investment in the stock of another company. The company's minimum required rate of return is 15%. In number 1, they ask us to calculate the company's average operating assets. So we have to go to the balance sheet and look to summarize our operating assets. And our operating assets would be cash, accounts receivable, inventory, plant and equipment. The investment in another company is not an operating asset, nor is land that is held for future development. That is not operating property. Another example of operating property would be a building that Joel de Paris owns but rents to somebody outside the company. They would all be considered non-operating assets. So we would add the beginning balance of the operating assets, which is $1,590,000, and we would add the ending balance, which is $1,650. We would take the average of the beginning and ending balance, which, as you can see, which would be the $1,590,000 plus the $1,650,000, which divided by 2 would give us an average of $1,620,000. Now, in part 2, they ask us compute the company margin, turnover, and return of investments. So with the margin, our net operating income is $405,000, and our sales is $4,050,000. So when you divide the net operating income of $405,000 divided by $450 million, your margin is 10%. Now to calculate turnover, you would take your sales of $4,050,000 and divide it by the average operating assets, which is $1,620,000. Your turnover would be 2.5. If you multiply the 10% times the 2.5, your return on investment is 25%. In the last requirement, number 3, what is the company's residual income? The residual income for a company is the amount of excess. It's the amount of the minimum required return of 15% times 1,620,000, which is $243,000. So we would take our net operating income of $405,000. The minimum required return is $243,000. So our residual income is what amount is greater than the not net operating income when you subtract the minimum required return. So we have a residual income of $162,000. And that makes sense because we just calculated their return on investment is 25%, but their minimum required is 15%. So it does make sense that there would be residual income in this scenario.